Is it true that the USA will see a leg down in housing over the next year? Meredith Whitney, founder and CEO of Meredith Whitney Advisory Group, joins Squawk on the Street to discuss what Whitney is seeing from the U.S. consumer, her thoughts on the economic prospects for each generation, and more. Let's delve deeper into her interview.
Owns less housing than they've owned in the past. So new home buyers are getting older, and that group, that cohort, owns less housing than they've ever owned.
86% do not own homes. That was one of our survey questions.
So there's no forced savings, and they like experiences, they like Instagram moments. They're not saving, so they're spending what they have. And as long as they have jobs, they'll keep spending. Now, the group that is doing incredibly well and who has so much cushion is the group that's over 38 that owns homes. So that's doing incredibly well. $21 trillion of equity has been created over the last decade, and home prices have gone up, over $23 trillion worth. So they've got a lot. They're sitting on a lot of equity. Now here's where things get interesting. Over 70% of the housing stock, all U.S. residential housing, is owned by people over 50. And the AARP estimates that over 51% downsize to smaller homes. That means, and this is, I think it's interesting in terms of how much consensus thought is built around U.S. housing. People think that there's mortgage lock because people don't want to sell their homes to get into another home with a higher mortgage rate. Well, older people don't have big mortgage debt outstanding. They can sell, and if you look at markets like Naples, 58% of home purchases last year in Naples were all cash. So people are downsizing, taking equity out, taking some of this $21 trillion of equity out, and buying all cash deals. Now, where this gets challenging is where the boomers have to sell their homes to somebody, and that becomes an affordability issue. And what's even more challenging is the states that I think are going to have the biggest challenges have older populations. So all of the states in the tri-state area, Connecticut, New Jersey, New York, Pennsylvania, Ohio, Illinois, they all have older demographics. They have much lower job creation. And so unless they lower their home prices, they're not going to see activity. So I think what you've seen is 4 years where people really haven't sold. Like the peak in existing homes, home sales was back in 2005. So people have avoided selling their homes. And that doesn't mean they can't. They just have to lower their prices. And with higher rates, home values are worth less. So I think over the next year, and this is going to be a multi-year phenomenon, you're going to see a leg down in housing. Now, that doesn't mean anything horrible for the consumer because, like I said, equity cushions are so big in the folks that own homes. So as long as home values could go down, I'm not saying that they will, home values go down to pre-COVID levels. That's a 40% move nationally. Obviously, it varies from state to state, and everyone will be fine. As long as the avocado toast generation keeps their jobs, they'll be fine. And I think the avocado toast generation could have multiple jobs. So they're working at home and they can manage having multiple jobs. So they're sitting on they have a lot of disposable income. If something really changes dramatically with corporations and they fire a bunch of people, which you're not seeing.
In this interview, financial expert Meredith Whitney discusses her views on the U.S. housing market and its impact on the overall economy. She provides insights into the dynamics of different age groups and their housing ownership trends, shedding light on the potential challenges and opportunities in the real estate sector. Whitney identifies a particular age group, which she humorously calls the avocado toast generation, comprising individuals aged 18 to 38. This group is characterized by having spending power but not accumulating wealth due to their lower homeownership rates. She highlights the fact that they prefer experiences over traditional investments like homeownership, and they are not saving as much as previous generations did. New home buyers, according to Whitney, are getting older, and this avocado toast cohort owns less housing compared to their predecessors. It's revealed that a staggering 86% of this age group does not own homes. This information is essential as it provides a glimpse into the changing trends in homeownership, with younger generations showing a preference for renting and spending their income on experiences rather than saving for traditional investments. Conversely, Whitney points out that individuals over the age of 38 who own homes are in a much stronger financial position. She mentions that this group has built substantial equity over the last decade, with $21 trillion of equity having been created, coupled with a rise in home prices of over $23 trillion. These homeowners are essentially sitting on a financial cushion, which can be used to leverage their financial positions if needed. However, where things get interesting, according to Whitney, is the fact that a substantial portion of U.S. residential housing, over 70%, is owned by people over 50 years old. AARP estimates that more than 51% of this demographic has downsized to smaller homes, indicating a trend of older Americans moving into more manageable and affordable housing. This information challenges the common belief that there is a mortgage lock, where people do not want to sell their homes to buy another with a higher mortgage rate. Whitney makes the argument that older homeowners, in most cases, do not have large mortgage debts outstanding, making it feasible for them to sell their homes and potentially benefit from the equity they've built. She points to markets like Naples, where 58% of home purchases were all cash transactions. This data suggests that older homeowners are downsizing, taking equity out of their properties, and investing in all-cash deals. However, the real challenge, as Whitney highlights, is the need for the baby boomer generation to sell their homes to someone else. This presents an affordability issue for younger generations, especially in states with older demographics and lower job creation, such as the tri-state area and other regions. The fact that existing home sales peaked back in 2005 indicates that many homeowners have avoided selling their properties, and the potential for a housing market correction looms if prices need to be adjusted to meet the current economic realities. Whitney predicts that higher interest rates may lead to a gradual decrease in housing values, which could impact the housing market for the next several years. She suggests that the housing market may experience a leg down, but this does not necessarily spell doom for consumers. She emphasizes that homeowners who have built substantial equity cushions will likely weather the storm. Even if home values decrease, as long as jobs are stable, the impact on homeowners' financial positions should be manageable. So Meredith Whitney's insights provide a comprehensive overview of the U.S. housing market's dynamics, highlighting the contrasting financial positions of different age groups. While younger generations may be less inclined to invest in homeownership, older homeowners have accumulated significant wealth through their real estate holdings. The challenge lies in the transition of properties from one generation to the next and how affordability and housing values will be affected by changing economic conditions. Whitney's analysis offers valuable perspectives for those interested in understanding the evolving landscape of the U.S. housing market and its potential implications for the broader economy.